Hello and welcome to Business Incorporated, coming to you live from Lagos, Nigeria. I'm Chimeze Obi Iwagu. Thank you for joining us. On the program today, Nigeria capital inflows more than doubled in the third quarter to $4.2 billion. And Sudan looks to unify currency rates by January. Plus, Kenya seeks proposals for $2 billion Eurobond sale. We get started now with the markets, and beginning here on the African continent. In South Africa, the JSE index rebounded 0.12% at intraday, taking relief from Moody's decision to only place South Africa on review for downgrade, while S&P Global Ratings downgraded the sovereign deeper into junk territory. Now, news that the government plans to reduce the fiscal deficit through expenditure cuts and higher taxes also helped the market. Egypt's market was also trading high after the central bank removed caps for the deposit and withdrawal of foreign currency for importers of non-essential goods, the latest sign of improving dollar liquidity at banks. And here in Nigeria, the index was a little off, down 0.02% at intraday. The market in Kenya closed higher on Monday, 1.41%. In the Middle East, stock markets there were narrowly mixed at intraday today, with Saudi Arabia edging up for a fifth straight day as it was boosted by the petrochemical sector. The Saudi index rose 0.49% as Chemonol gained 1.2% and Petroraf added 0.4%. In Qatar, the main index fell 0.43% despite a 0.5% gain by Qatar National Bank, the region's largest bank by assets. Our Qatari Investors Group, a conglomerate which last week traded at its lowest level since 2013 and has been rebounding sharply in heavy trade since then, added 1.2%. In Dubai, the index fell 0.46% as Emma Properties slipped 1%, but Drake & Score rose 2.3% in heavy trade. It announced on Monday that its shares had been included in the MSCI GCC index. In Abu Dhabi, the index went up 0.48%. However, Manzil Real Estate, the most heavily traded stock, fell back 1.8%. It had risen earlier this week when it said plans were underway to expand into Middle East and North African markets. In Europe, bourses were slightly higher in early trade as investors looked out for tax reform plans in the U.S. and comments from the next Federal Reserve chair. And for more, let's talk to Daniel. Good afternoon, Daniel. Thank you very much for joining us.
Good afternoon, Jimmy from Frankfurt. I can tell you all the Christmas season is really getting started. I just went for lunch for the first time here to the Christmas market. We're really getting close to Christmas.
Really? Oh, I can say, of course, Christmas is in the air, and I'm looking forward to that beautiful celebration and a lot of eating at that time. Well, Daniel, U.S. President Trump's Fed chair nominee, Jerome Powell, is set to be questioned at the Senate. What comments are investors looking to hear from Powell?
Yeah, it's going to be a really interesting meeting. I mean, George Powell, he has been in the Fed already for quite some time, and I was talking a little bit earlier to investors, and they don't really know what are really his opinion. He is kind of like this unwritten page for them, basically. So it's going to be really interesting when he will be questioned in the Senate. We remember that George Powell was already in the governor position at the Fed, pretty much following and also agreeing to everything that Ms. Yellen has done in the past. So investors are expecting that he is going to drive and have a very similar politics, financial politics that we have seen already in the past. But of course, in the end, we don't really know what he's going to say. He released a statement earlier yesterday stating that he will be promising continuity uncertainty for the United States and also for the market, which most likely is going to mean that we'll be seeing also in the future again higher interest rates, but you know, not dramatically pretty much rising interest rates, but in general, you know, a slower move for those higher interest rates. So that's at least what investors are expecting to hear. Let's see what he's at the end really going to say.
Now, today, the Bank of England released the latest results of its banking sector stress tests, showing none of the banks assessed need to raise extra capital. How does this report fit into the broad Brexit conversation?
Well, I guess two things are very clear. On the one hand, when we're going to see a Brexit, that this is going to harm the United Kingdom. It's not going to destroy the UK, but for sure, at least the beginning is going to be quite a roller coaster. So the Bank of England has been releasing a statement today saying that they feel very much prepared for a Brexit, also when it comes to a hard Brexit. And this is all because major banks in the United Kingdom have been kind of playing a model, what could happen during a hard Brexit. So they were taking all those circumstances into consideration, like a dramatical economical downfall, a pound even dropping stronger, falling housing prices, fewer credits, higher unemployment in the country, and higher interest rates. So pretty much a horror scenario for every banker and for every analyst. And the result of this model was that all the big 7 banks in the United Kingdom were passing. Just Barclays and the Royal Bank of Scotland were struggling. But analysts here also in Frankfurt are telling me that at the end it's going to be easier for banks with a higher own capital. And that's why pretty much we are seeing this what the Bank of England is now doing. You just mentioned it, that they need to raise extra capital.
Right, still talking about banks, Societe Generale has announced plans to close 15% of its branches and